Let's talk about something tough. What happens when your home is worth less than your mortgage? It's a really scary spot to be in, but you do have options. Today, we're going to break down the two biggest ways people navigate this kind of financial distress: short sales and foreclosures. We'll get into the process, the consequences, and how you make these incredibly difficult choices, starting with one single number that shows just how many people are going through this right now: 2.8 million. Let that sink in for a second. That's how many homeowners in the US are what we call underwater, meaning they owe more on their mortgage than their house is actually worth. So this isn't some tiny niche problem, right? This is a reality for millions of families. And when you're in that position, one term becomes absolutely essential to understand: the short sale. So what is a short sale anyway? Well, you can kind of think of it like a negotiation, a deal you strike with your lender. You sell your house for what it's worth today, even though that's less than your loan. And here's the key part: the lender agrees to take that smaller amount, and hopefully they forgive the rest of the debt. But getting to this point always starts with a very specific problem. So how does someone even get into this situation? It's almost never because of one bad decision. Usually it's a life event that just comes out of nowhere and completely pulls the rug out from under you, like we're about to see here. Yeah, behind that huge 2.8 million number are real people with real stories. Let's take Jim and Nancy, for example. Their story is one we hear all the time. Jim loses his job, their income just tanks, but that mortgage payment, it doesn't change. And this kind of struggle actually has an official name in the lending world. And that name is financial hardship. And you have to understand, this is the key. It's what opens the door to options like a short sale. This isn't just, oh, money's a little tight this month. No, this is a provable major life event, like losing your job or a serious illness, that makes paying that mortgage impossible. And once your lender agrees that you're in a real hardship, you find yourself at a major crossroads. This is it, the big crossroads. And the choice you make here, it's going to affect your financial life for a long, long time. So what's the choice? It really boils down to this. Do you try everything you can to keep your home? Or do you figure out the smartest way to walk away? And for each of those paths, there's a whole different set of options. Okay, let's look at path number one: trying to keep your house. The whole goal here is to make that loan work for you again. You might be able to refinance to get a lower rate, or maybe get a forbearance to pause your payments for a bit. It's all about negotiating with the bank to try and stay in your home. But sometimes that's just not in the cards. So that brings us to the other path: leaving the property. Now, this could be as straightforward as selling and bringing your own money to the table to cover the difference, or something called a deed in lieu, which is basically just handing the keys back. But really, the two options you hear about most are also the most complicated: the short sale and the foreclosure. So let's dive into that short sale first. All right, so if you decide a short sale is the way to go, get ready. You're basically stepping into a high-stakes negotiation with your lender. And hurdle number one right out of the gate is proving your hardship is the real deal. And you've got to know banks are super specific about what they consider a real hardship. Things they can verify, like you lost your job, you have huge medical bills, a divorce. That stuff usually works. But if you tell them you just want a bigger house or you're upset you lost equity, nope, they're going to shut that down almost every time. But if your reason is valid, then the real work begins. Honestly, the process is a total paperwork marathon. First, you've got to officially prove that hardship we just talked about. Then you have to put together this huge package of documents. I'm talking pay stubs, bank statements, tax returns, a letter explaining everything, the whole shebang. You send all that in with an offer from someone who wants to buy the house, and then, well, then you just wait. And this is where it gets really nerve-wracking. There is zero guarantee the bank will say yes. At the end of the day, it's the investor who owns your loan that makes the call. They could just say no, or they could ask for more money, or they could just drag their feet until the whole deal falls apart. And if that happens, you're staring down the last and usually the worst possible outcome. And that, of course, is foreclosure. This is the official legal process where the lender just takes the property back. It's what happens when every other option has failed. And how it all plays out? It actually depends on the paperwork you signed way back when you first bought the place. Yeah, the process isn't one size fits all. It can go down one of two main roads, and it all depends on your loan type. If you signed a deed of trust, you're probably looking at a non-judicial foreclosure. If you have a mortgage document, it's likely a judicial one. And the main difference between the two? It really just comes down to whether or not you're going to court. Okay, let's break that down. A non-judicial foreclosure is way faster. Why? Because when you sign the loan papers, you basically already gave the lender permission to sell the house if you stopped paying. No court, no lawsuit. But a judicial foreclosure? Oh, that's a whole different ballgame. That's an actual lawsuit. The bank has to sue you and a judge has to sign off on the foreclosure. As you can imagine, it takes a lot longer. So look, whether it ends with a short sale or a foreclosure, the story isn't over just because you've moved out. Not even close. The financial fallout from this can stick with you for years, especially when it comes to something really important, like trying to buy another home down the road. And this, right here, is where that choice between a short sale and foreclosure really hits home. Check this out. If you want a standard home loan after a foreclosure, you could be waiting 7 years. 7! With a short sale, that drops to 4. And for FHA loans, the difference is even bigger. 3 years after a foreclosure, but maybe only 1 year after a short sale. For a lot of people, that waiting period is the biggest factor in their decision. And here's one last really important thing to know about your credit score. Yes, a short sale and a foreclosure both hurt, but you know what often does the most damage? All those missed mortgage payments before you even get to that point. A lot of the damage to your credit is already done long before you ever lose the house. So when you look at the whole journey, from that first moment of crisis all the way to the long-term consequences, you realize something pretty profound. A home is so much more than just a financial asset, right? It's like the anchor for our entire financial life. And it shows how one single, unexpected event can trigger this cascade of really, really tough choices. It kind of leaves you wondering, doesn't it? When we sign on the dotted line for a mortgage, do any of us really understand the full weight of the risk we're taking on?